I don't know. Do you have different hoodies for different purposes? You're not a coder, you're an insurance person. So when do you actually
No,
do
I
the
mean,
hoodie thingy?
I think it's just the pent up of wearing a suit for 20 years of my career. I've jumped over to the InsurTech startup and I've embraced it. And I think I've never looked back now. This is dressed up for me today, which is good. But yeah, no, I think some days you just want to put a nice hoodie on. Just kind of makes you feel good, and you can get to work.
Man, let me find a tracker's hat for a second, just for the
I like it. There we go.
that's
I like it.
that's
There
the
we
best
go.
that's the best I could find in terms of a tracker hand because we are going to talk about trackers and cover with.
Yeah, well, so it's interesting. I mean, I think the initial kind of startup was focused on really like in the marine, kind of a cargo play, and kind of launching an MGA that was focused on that, and therefore kind of the cover and then the whale kind of fit with that. I mean, obviously since then we can chat a lot about it today, but the organization has grown pretty considerably, really focused not just from those in the marine routes, but much more to the overall commercial auto space. And yeah, I mean, so it's a fun question to get. At times I wish we had a better response for the genesis of the name, but it served us well so far.
Now, I'm sure that there was a point that you thought that, you talked to one of the investors that told them, we have a vision. One day, we're going to be the whale in this little pond of a $6 trillion dollar industry. So we set the rough high. We know where we're going. It's in the name. I can see that happening. I can see that conversation.
Those are the conversations that are taking place now. Yes, I would say. I mean, interesting enough, and we can chat about it today over the course, but we've not been heavily reliant on investors. We were
Mm-hmm.
a bootstrapped organization, kind of built from the beginning on, how do we build a long-term sustainable business that can run on its own? We have raised some money along the way, but much different than I think most insurtech paths. Is kind of the path that we've taken right now. So obviously, a lot more conversations with investors with what we've been able to accomplish. To date, but I'd say early days, it was like, hey, let's just put our heads down. Let's actually build an entity. Let's bootstrap it. It was a $200,000 friends and family round, and got that organization, really to the point where we had processed thousands of policies. We had partners that were live for carrier partners, had reached cash flow positive at that point, and then did go do a seed round where we raised, just under 16 million, which really gave us an opportunity to kind of just build into who you are today. And that round took place a little under 2 years ago. So yeah, I mean, now we are having conversations about, conquering the world and being the whale. But, it only happens at a point when, it's better to, I guess I'd say, deliver rather than just talk
Mm-hmm.
about things. So, a massive premium run rate right now, kind of close to, just last month was our best month, puts us kind of closer to 400 million. So from that standpoint, now it is a case of like, okay, we've got loss ratios in the low 50s. How do we grab some more of that market
Wow.
share as long as we can do it profitably?
Wow. Since we already broke the frame or the structure that usually I have on the podcast, let's continue with this. So, who led
Yeah.
your first funding round and who are the founders? Sorry. Who are the investors?
Yeah.
And then we talk about the founders.
Yeah, I mean, it's probably easy for me. I'll give you a little bit of background on myself because that will kind of maybe take us through the story of the fundraising. So, I started my career on the underwriting side. I joined out of, a finance major out of college and did what, most people do is just landed up in insurance through dumb luck, but started on the underwriting side through Gen Re, which is a Berkshire Hathaway entity, and then Swiss Re. And, maybe I was there for about 5 or 6 years and then decided to make the leap over to reinsurance broking, so kind of what I'd call the dark side. Spent about a decade at Willis Re at the time. Kind of went through a little bit of a midlife crisis at the time of insurance of do I want to stay, do I want to go? Ended up going back and get my MBA, and I'd say maybe halfway through that first year of my MBA, I guess kind of really realized that maybe the grass wasn't always greener on the other side, and and found that, insurance had a ton to offer. And it was, though, at that point where I did kind of realize I wanted to get more towards the entrepreneurial side of the business, and either go launch something or get closer to, a smaller kind of earlier startup company where I could at least, I don't know, I like to say kind of move the dial. I joined Tiger Risk at the time, and I was over there to really launch their specialty casualty division, as well as led their InsurTech segment. So now this gets to maybe your question, but as I was kind of leader at the InsurTech segment of Tiger, I did have an opportunity to meet many different kind of tech founders that would come through the door looking for capital, looking for capacity, or looking for advisory services. Most of which were tech founders who were couldn't really spell insurance but wanted to disrupt this archaic business called insurance. One of those founders that I did get a chance to meet was Dan Abramson, our founder and CEO. So very early days, got to work with CoverWell. They became one of my clients. I helped launch a couple early stage programs while I was still at Tiger. And then I guess, looking back, it was, I guess we like to say, maybe a year job interview for both of us just to see if, both of us wanted to work together, and then made the leap about, a little under 2 years ago to join as president of CoverWell. But really, I think that the conversation with Dan of me joining was really like, what did he want out of this organization? Did he want to take the opportunity to really, put his foot on the gas and try to accomplish something special here? Not to say that building an MGA isn't special, but I think, we very clearly saw that there was an opportunity. So as I had mentioned, we were at the time cash flow positive. We were making money, but we did go out and we found some really good partners through a seed round where we raised just under $16 million. That seed round was led by Ambac Financial. They've got a subsidiary, Everspan.
Yeah.
Everspan is one of our largest participatory fronts, and they've been a great partner. They've been fantastic along the way and helped kind of be very strategic to us as we build our business. Equally, Tiger Risk was a investor once I kind of left. I think they were very happy to also support me in the next step in my career. So
I had the opportunity to. I had the opportunity to talk with Steve several times about his strategy in terms of the MGM and how the MGAs and how they approach that from Ambac and stuff like that. And they are doing very interesting moves in the industry, and kudos to them. But sorry, I interrupted you in the flow.
No, so, that was good. I mean, that was spot on. I mean, I think that those are the investors though. So yeah, but it happened about a little over a year and a half ago. It's been a good relationship with them. But yeah, we are obviously in talks now. Just the growth of the business has gotten to the point of a next kind of plateau for us. And I think we're at the point where, I think we want to reinvest in the business, continue to really capitalize on what we're trying to build here.
So Ambac are great, right? That's their business, especially Evergreen. They see that. I consider them as a strategic investors and the leaders in your case. Who else invested in you? Was it pure VCs or also insurance companies that invested out of their balance sheet?
Yeah, no, I mean, it was really truly limited to a couple angel investors. Tiger Risk, once I decided to leave, they did kind of one of their subsidiaries put money in, and then Ambac. So we definitely were in conversations with a couple different suitors, but we felt like those were the best strategic partners for us for that next step. So, to date, those are really it, other than some friends and family. So it's been very limited. We've tried to be very resourceful. We've tried to be very smart. We do, want to spend our money wisely, and make sure that, we're not getting out over our skis. We want to be able to execute on the business we have. And really, I think that's been kind of the focus to date for sure.
Yeah, I think it's a very interesting landscape in terms of the investments, because we've seen several waves of types of investments, and most of them started with, we are a big reinsurance. Let's invest from our balance sheet into this company because we see that strategic opportunity. A few of them originated with AXA Ventures, etc.
Yep.
We actually have a venture arm. Let's structure it and put in American Family Ventures. Now I think that now they finally have a second LP, not just AmFam, and then of course you have the specialized funds that go to the insurance companies like, hey, we'll invest your we'll invest it for you, right? And we'll do something that will also somehow pay to your strategic insight and where you're going with the company and the ecosystem itself. Let's talk about the team, the founding team, and I'm sure that people ask you that, and we joked about it earlier.
Yep.
You and Daniel.
We are not brothers.
I know it's
yes.
Exactly. Thank you very much.
Yeah, not
completely
brothers.
Different. Of course, not even
I would
related.
I would be the younger, better looking one if we were, but we are not.
I have a feeling that he will disagree, but sure, let's go with that, man.
Fair enough.
So where do you guys stand now? What's the size of the team? And 2023, is that an opportunity for you, or is it everyone is just shaking and not really sure what's going on?
Yeah, no, it's exciting times for us. So we're probably north of about 150 kind of employees and contractors right now. You look back, 2 years ago, and we were low single digits, right? So from that standpoint, it's been a big growth, story from a standpoint of not just kind of our business, but also the people. We are very, very aggressively trying to attract A-talent people, though. That is where I spend a ton of my time. We are, I think as we kind of look at this inflection point, I am spending a ton of time with investors as well and getting to know them to see who maybe could be the next strategic partner for us as we lead forward. But I think right now, even just had a meeting with our chief people officer this morning, I think we have 32 job openings right now. So we are really trying to take advantage, I think, some of this dislocation in the market, not just the tech field, but also a lot of these insurtechs. Most have laid people off, a ton of opportunity to hopefully attract some really strong talent. And quite frankly, just, use this as an opportunity to build on the business. It is the business itself at the core is in a really good shape. And, we're at a really nice point in time where we can invest in the business, attract good people. So, I'd say probably north of 150, but probably that'll grow pretty considerably through 2023.
Yeah, the talent challenge is very interesting. It's a great opportunity to find amazing talent that just for the, 10% cut was lay off or saw a new opportunity because things didn't work out. And so I don't know, most likely this episode will go out in 2 weeks. A few days ago, I commented on a LinkedIn post by Anir Perry from Cyberite, another body. And he basically hired Hemot May from who used to be in Allianz. And my point there was, everyone is talking about a recession, but look, who is hiring whom and why? And that will give you not the red flag, the green flag. These are the startups that actually have the agility and the resources to hire the best talent and even increase the growth. They're already on a good trajectory up. They're going even higher. And I'm just echoing things that I said. But you, especially if you're profitable and you have runway, that's the time, to spread the net. Although net, it's you just get a larger population. You really need to cherry pick, no matter what it is.
Yeah, I mean, I think, I think building a culture through COVID is very difficult, right? I think that's something that, is a challenge for, I think we're not the only one that I'd say at times struggled through that. We've been now working together, and we're double down committed on trying to really make sure that we are, startups aren't for everyone, right? I think some people think that they want to work at a startup. But it is a different kind of mindset here in order to be successful. It takes a different type of person. And, we are spending a lot of time and energy to try and, flush that out from both sides. Not just trying to attract A talent, but making sure that A talent understand what they're getting into with CoverWhale. It's an amazing opportunity for what we're building. But there's a sense of urgency. There's an opportunity here. We are going to take advantage of it. But we push pretty hard. It's not something that I won't be in the trenches with somebody. It's not something Dan won't. It is very clear, we're all kind of arms are locked, but it is, to your point, it's very time consuming to get the right people that are going to fit that culture. I think we are still on a growing side as an organization, but that culture piece is extremely important to us. It's a bit of a work hard, play hard mentality, and you just want to make sure that we're spending a lot of time and energy trying to solve problems. You want to make sure you're doing it with people that you really like.
So when we look at, fighting in the trenches, building an insurance company, if you're in early stage and you'll come to me, one of the things that I will ask you first is like, do you have a distribution channel? Then do you know how to underwrite, or what is the niche? Are you,
Sure.
If you're car insurance, don't talk to me, man, and think about a new idea. But that's, something else. So by the way, what are you using for your distribution channel?
Yeah, so our distribution right now is really traditional channels. We work through traditional retailers and wholesalers. I think in our minds, look, these partners of ours, they control business, they add value in the value chain, and they've been very helpful for us to kind of access the business that really fits our appetite. So I think that's kind of been the key piece through distribution to date.
And with that, as you are fighting in the trenches, it's all about the combined ratio. So how, and we talked about it earlier, how do you manage a 50 points combined ratio?
Yeah, so not combined ratio, but that low 50s would be our projected ultimate loss ratio. So if you think about that, still would say is still market leading, from sure. But we are, so if you think about it, CoverWell, I would say we are a tech company focused on really changing the landscape of insurance and really trying to make the world safer. So we're doing that by bringing a proprietary tech-enabled platform that leverages, and I'd say most importantly, digests just massive amounts of data that's real time, and really with the goal of try to more accurately price the risk up front. Now, right now as a firm, we are an MGA, so we're focused on commercial auto space, as we've touched on. And, trucking has kind of been our backbone to start. We've expanded into commercial auto. But look, in the end, for any insurtech or even a traditional player, it's about pricing risk and who can do it better, who can do it faster, who can do it more accurately. There's a ton of data that exists out there, but who can digest it, who can make sense of it? I think the class of maybe InsurTech 1.0 maybe prioritize growth at all costs. I think our view is much different. Leading that movement of bottom line profitability is key, and I think it does start with we have a lot of tech people that at the core, I think like many of us are insurance people in this organization. We are utilizing tech to really find the efficiencies in the model. How do we leverage data to get to a better outcome when it comes to pricing the business up front, and then really I think trying to get visibility into the risks that we're putting on our partners' balance sheets, but really get visibility real time. So we have continuous underwriting models that are taking place so that we are, through telemetry data, second by second, we're able to analyze our insureds and identify who the riskiest of those insureds are, and then, quite frankly, coach them to make them less risky before the event takes place. So it is a balance of, hey, taking that data, processing it, digesting it very quickly to, provide a value proposition to our distribution partners where within seconds, we're able to offer them an instantaneous bindable quote, as well as then, hey, how do we now, once the insured is on our partner's balance sheet, how do we monitor that? How do we provide, embedded loss control to really kind of limit the loss before it happens, if that makes sense.
It makes sense. And I'm just trying to visualize it. How the driver, is it the driver who received the information or the business owner?
So, both. I mean, in a way, many of the insureds that we work on are owner-operators, single power unit. So for those folks, they are both. In other aspects of it, it could be somebody more, our focus has been on more the small fleet. So it is both. It's, coaching is going directly to the driver. Also, the owner is aware that, hey, driver number 7, has, is sped, 10 times in the last 10,000 miles. And that's higher than, 97% of our other drivers. And here's some coaching things that we'll do. So it is a bit of a twofold. But oftentimes it is direct to the driver and letting them know, like, look, many of these, drivers, they do look to us as their loss control. They want their vehicles to be on the road. From that standpoint, for many, especially these owner operators, if their vehicle's not on the road for 2-3 weeks because of a fender bender or something else, maintenance, they could be out of business. So I think it is, I think coupling it with, coaching appropriately to the drivers, but then also making sure that the business owners are aware. I think that's been a learning curve for us, quite frankly, to make sure we were communicating, appropriately to the right stakeholder. But it's been something that I think we've really fine tuned over the last couple of years, but also an area we're just getting started in. So it's exciting when we think about the data that we get, and what we can do with that, from a standpoint of even gamification on the positive side of things for the good drivers, and how we kind of retain those. So it's kind of a fun point in time where we've got a ton of data. We've been at this now for 3 years. And, I think unlike many insurance carriers, a lot of them have, loss data and premium data. And then there's a lot of telematics providers that have that second by second telemetry data, but they can't couple that with insurance loss or premium. So we've got both, and we are at a point in time where there's, statistical credibility that, still, while we could argue whether our projected ultimate is going to be, loss ratio is going to be 53 or it's going to be 56, directionally, the data that we have gives us really strong confidence of what we're building. And, I think kind of where we're going, I think that's what's exciting. I wouldn't say that we figured it all out. I think we're learning every day. But that's the point in time where we are in our life cycle that, we're kind of in the roll up our sleeves and try to see what we can find out and get any insights we can from this data.
Now, when I went on the website and as a prep for this conversation, I was very impressed that you show a map of the different products, and if you are admitted, if you are selling the insurance through other channels, and the different states that you're actually operating in. What made you choose? And it's more, now it's more of a, let's call it a behind the scenes insurance conversation. Why are you admitted in a few of them, which surprisingly in Florida, you're an admitted admitted product versus other states?
Yeah, so there's certain, so there's certain states where you really need to be an admitted, you have to have an admitted product offering. You're unable to kind of offer non-admitted. So from that standpoint, some of it is just geographically kind of determined by the actual state themselves. In our minds, though, we right now we work with about 10 different kind of carrier partners. Different programs are set up. In our minds, right now we believe in what we're doing. We believe in from a standpoint of the loss ratios, but also too from a standpoint of we want our partners to grow with us at their comfort level, right? So some of our partners want to, start in a certain geographic region, maybe stay away from a certain geographic region. Some want to kind of, hey, just trust CoverWhale and say, look, you guys are the experts. Let us fully do a trust fall, and you tell us how to build a portfolio of X amount of premium. But it's really kind of been driven off of our partners and that geographic expansion. So, I think at the core, I would say the thesis from our side is, though, we've got a very conservative kind of underwriting appetite early years. I think it is the insurance. I spent the 2 decades in kind of the reinsurance and program launching and begging for capacity. And that's not lost on me, right? I think you can't burn your capacity partners. That is important for what we're going to build. And, in our minds, we'd rather be more conservative in the early years, have that data come through, gain some more credibility, get smarter every day, and then, really get more shots at the top of the funnel. So, I think if you think about it with very little kind of increase in appetite, we issued about 6,000 quotes last January versus, 35,000 quotes just this January. So we are getting more cracks at it at the plate, which is allowing us to grow, but we don't have to, go out and chase business. We don't have to go out and chase business from a price standpoint. Our technology has really, really strong efficiency to allow us to handle increased flow, increased shots, but not have to go hire, 100 new underwriters every year, if that makes sense.
And that's the beauty about technology, and especially AI, that helps you to scale decisions, right? It's not just,
right,
okay, I need another person to do that, or there is a certain algorithm that can do that with a marginal cost of almost zero and handle the larger population, which is not easy because even an algorithm, if it's a simple one or actually with an AI and ML behind it, there is a lot of money that goes to make that happen and maintain it. And people go like, AI.
Yeah, no, I mean, like, look, I think that is, the amazing thing about it is, we do as a leadership team, we talk a lot about, where the business has been, where the business needs to go. The beauty is there's no real, like, firm roadmap that says this is how you build an insurtech. You really have to be willing to push forward as quickly as possible, but then learn. We get a lot wrong here. The team, it's very uncomfortable at times to just say, hey, we're going to move with 80% certainty. We're going to make decisions and we're going to go. And I think for some people that come from maybe larger organizations, that's very, uncomfortable, right? They're moving quicker. They want to get to 100% certainty before they put the plan in motion. But I think it's where do we deploy the AI? How do we use the data? How do we really kind of reduce friction with our distribution partners? How do we make it, instead of, hey, 2 minutes to get a, bindable quote, how do we get it to seconds? Those are all, really items that are conflicting from a sense of, you do have limited bandwidth, you do have limited tech resources. So where do you deploy them? And that's, I think, the fun thing that we're kind of in as you really try to build a business. You got to get to that core. In our minds, the loss ratio is the North Star for us. Everything will come together if we can deliver market leading loss ratios. Expense ratio, the technology is helping to take care of that, right? From a standpoint of, I think if we were full stack insurance carrier, where our loss ratios are about 60% of our competition. And that alone, that's where we deploy the technology, which is, once again, it gives you a lot of flexibility to kind of have some fun with maybe where you want to utilize the data, how you want to look at it, where do you want to kind of, put the AI and things like that. So every day it changes, which is, fun and also a little nerve-wracking, right?
Connects back to your North Star is the expense ratio and the combined ratio, and understanding that this is the way to grow. This is how you build an insurance company. Unlike the first generations that we've seen that started with what we've seen in regular startups, it's just, let's get traction. Yep. Now we have users, not policyholders. We have so many users, or we have this type of KPIs. But as much as I love specific startups that went public and cost me deep red on my portfolio, they still need to work on their combined ratio.
Yeah, I think that's the interesting thing, right? I think it is. We've gotten to this point without really setting out to say, hey, we wanted to reach this milestone by this time frame. In our minds, it was that North Star is always going to hold true for loss ratio. Everything we will do, but we'll grow as much as we possibly can as long as that North Star holds. I do think, with a high level of certainty, I can put the stake in the ground that says we are the fastest growing insurtech ever. I think we are the most profitable insurtech to date. We've done it on very little money raised at $16 million. That's a 1.6, not 160 or 600 like many of our competitors, and we've done it where we're cash flow positive. In our minds, you've got to run you got to run a business, and I think when you have all that, like you've got enough bumpers that are up where you're not going to get out over your skis, you're not going to chase business. But I think in a way maybe that approach also did afford us. I don't know, if we would have raised, a couple $100 million, I'm guessing we would have made some bad moves early days, like many of these other folks did. Now we're at the point, I think we understand our business. We know what our business needs to get to that next level. And I mean, I think this is the point where we're at that inflection point again of like, look, we can continue on this path. But I think in our minds, this is once again, let's double down, let's triple down, and really try to fuel that growth. But once again, it is not for top line profitability, top line numbers. It's bottom line profitability. We've got, as I said, some very strong kind of partners, many of which are, 2 decades plus relationships I personally have with them. And I don't take that lightly. I know how hard it is to attract that kind of capacity and the relationships. And that's an area for us that I think it's exciting. But we want to do right by our partners. We are kind of stewards of their capital, and we believe in it. We take risks from a standpoint of we'll do well if they'll do well. From that standpoint. So we're kind of all in it together. Our interests are aligned properly. But it is. I think it's insurtech right now is maybe not the best word to throw around with maybe some of maybe the past issues, but I don't think we care what we get called. I think we're just really proud of what we've built, kind of focused on the opportunity. It really is about execution. I think that's truly where we are at this point in our life cycle. We don't have to go out and do anything crazy. The business is coming to us, and we've got to really just execute on it and continue to kind of pull. I don't know. It's almost like a mosaic of like 50 things we've got to do right. It's not just one. Like right, one thing is not going to
Mm-hmm.
save us. We've got to piece this
No.
all together. It's moving the Plinkos around, and I think that's kind of once again it's the challenge, but it's also the fun aspect of what we're trying to build today.
Can't agree with you more. Okay, now because we completely broke the common structure that I have for this podcast, which we start with, some sort of a hobby and show your personality, and we just jumped in. And I have no idea how we're going to cut this episode to the different chapters because it went like all over the place. Let me jump to the first question and then the
Sure.
last question that I usually ask people. And the first question normally we just sort of slide into that conversation about a hobby, the personality, the fact that you're coaching, or are you the judge? What do you
Yeah.
exactly with them? Is it minor leagues?
Yeah, no, yeah. So I coach a couple different
Coach.
basketball. Yeah, I coach a couple different basketball teams right now. We're in AAU, so my son is 13 years old. It's a travel AAU, pretty competitive league. So we're kind of in that mode right now. So that's kind of where we spend a lot of nights when I'm not up here in New York at the office, and the weekends for sure. But kind of fun ages with the kids. I mean, they're definitely pains, but they're also like great ages with 14, 13, and 9. So they're keeping us busy for sure. Right to kind of also, do anything kind of outside, ski and different stuff with them. They're like I said, just really at fun ages where, even something like that, it's still cool to be with dad. Most other times it's not, so I'll take it while I can get it.
Well, if the kid is 13, a few more months, maybe a
Yeah,
year, and that's
that's
it,
right. That's
done.
right.
Then it's like, dad. Then it's, I don't know, after college, they realize that parents are good again. I don't recall. Whenever they need a check, it's fine. No worries.
Yeah,
I don't
yeah,
judge.
no, that's right. That's right. Yeah, yeah.
And then, of course, my last question to you is, can you give the audience a word of advice? It can be a recommendation. It can be about a book that you read recently, an amazing restaurant, a destination for travel, some sort of a managerial tip, whatever you think people should know.
Yeah, I mean, look, I think like, look, one of the things if I look back on my just, personal life, my, career, I think where we sit at Coverwell today, look, I do just give people personal advice that like life is hard, life is difficult, and I think, look, I think you got to have grit while you're going through it. I think that is, I think, a very important aspect. I do talk about that with my kids. They get annoyed, but roll their eyes of, oh God, here comes another lecture from dad, but that is, I think, important in all aspects of life. And it prepares you for whatever kind of you're faced with, whatever kind of challenge you're faced with. And I think, like, as I mentioned earlier, like, look, I think what we are building is hard. This isn't easy. There's plenty of other places to work that are much easier jobs. But I think, when you kind of have grit, when you're going after something that's kind of, and you're able to persevere through it, I think the reward will be there. And I don't view it as the reward as any certain milestone of, reaching a fundraising round, or doing X or doing Y. In my mind is like, you got to actually, in a weird kind of way, you got to love the journey. Nobody's really going to pat you on the back. So if you don't truly love that journey, whether that is, training for a sport as a young child, It's not just about holding the trophy at the end. It's like you actually got to love those summer workouts where you're sweating and exhausted. And same thing with like work here. I mean, I think if you're not enjoying the journey to really solve the problems that are facing the fire drills that pop up on a Friday afternoon, it's probably not for you, and go find maybe something else that would make you happier. So I'd say, kind of having grit in all aspects of your life, that'd probably be the one thing I would pass along to the audience.
I love it. I think that people don't understand what grit is, and I don't have too much access to the younger generation, but I would recommend with that, send your kids. Actually, it's not only kids, it's adults as well, no matter what's your age. If you want to practice grit, go pick up a martial art, because it, as judo, or nowadays it's more of the jiu-jitsu stuff, you need to learn how to fall on your back and lose, how to face so many failures and stand up, because that's what it is. It's grit is the ability to bounce back, connect to humble your, I don't know, humble it, and knowing how, okay, failed, I can try again. I'm going to fail again. How can I be better? How can I make sure that I will survive 2 more seconds, a minute, get an ippon, wazari, whatever that you need in order to move to the next step. And it's not simple. It's very hard mentally, physically, and that's a great way to practice it. I love the fact that you brought it, because I hear, so especially in startups, many people talk about grit, but they don't really know how to define it. And this is wonderful. Great opportunity. Kevin, thank you
Appreciate the time
very much.
Thank you.